Have you ever dreamed of financial freedom, of making your money work for you, and navigating the unpredictable waters of the stock market with confidence instead of fear? If so, you're in the right place. Welcome to a journey into the timeless wisdom of Benjamin Graham's The Intelligent Investor, a book revered by legends like Warren Buffett and considered the Bible of value investing. This isn't just another book summary. It's your roadmap to understanding the principles that underpin sound investment decisions. We're going to break down the core concepts of this masterpiece into actionable insights, showing you not just what Graham recommends, but how you can actually implement these powerful strategies in your own investment life. By the end of this summary, you'll have a clearer vision for your financial future and the tools to build it intelligently. So grab a notepad, settle in, and get ready to transform your investment mindset. We'll be covering the key ideas across 5 chapters for this video summary. Chapter 1: Investor versus Speculator. Knowing your lane. Graham begins by drawing a crucial distinction that many investors, even seasoned ones, often blur. The difference between an investor and a speculator. An investor, according to Graham, is someone who performs a thorough analysis of a company's fundamentals, its financial health and its prospects, and then purchases its securities at a price that offers an adequate margin of safety. Their goal is to acquire a suitable security at a suitable price, holding it for a long term and expecting a reasonable return. A speculator, on the other hand, is primarily concerned with anticipating and profiting from market fluctuations. They are more focused on the price movements of a stock rather than the underlying value of the business. Speculation, for Graham, is not inherently wrong, but it's a different game with different rules and significantly higher risks. He emphasizes that if you're not conducting thorough analysis and buying with a margin of safety, you're speculating, even if you don't realize it. Example: imagine 2 people looking at shares of a tech company. The investor would meticulously examine the company's balance sheet, its revenue growth, profit margins, competitive advantages, and management quality. They might determine that, based on its earnings potential, the company is worth $100 per share. If they can buy it for $70, that's a good investment. The speculator, however, might hear a rumor that a big tech conference next month will announce a new product from this company, causing the stock price to jump. They buy shares today, hoping to sell them quickly after the announcement, without much regard for the company's long-term financials. Based on what has been expressed in this chapter, you should consider clearly defining whether your actions in the market are based on thorough analysis and a long-term perspective, or on anticipating short-term price movements, and adjust your strategy and risk tolerance accordingly. Chapter 2: Inflation and Investment Policy. Protecting your purchasing power. One of the most insidious threats to an investor's wealth is often overlooked: inflation. Graham dedicates a significant portion to discussing how inflation erodes the purchasing power of money over time. He stresses that investors must not only aim for nominal gains, but also real gains. If inflation is 3% and your investment only yields 2%, you're actually losing purchasing power. Graham argues against fixed-income investments as the sole components of a portfolio during periods of high or persistent inflation, as their returns may not keep pace. He suggests that common stocks, particularly those of well-established, financially strong companies, offer a better hedge against inflation in the long run. This is because companies can often pass on increased costs to consumers through higher prices, thus maintaining their profitability and, consequently, their stock value. Example: let's say you put $10,000 into a savings account earning a fixed 1% interest rate, while inflation is running at 4%. Based on what has been expressed in this chapter, you should consider how inflation impacts the real return of your investments and ensure your portfolio. Strategy includes assets such as well-chosen, common stocks that have historically demonstrated the ability to protect and grow purchasing power over the long term. Chapter 3: The Defensive Investor's Portfolio. Building a foundation of security. For the defensive investor, someone who seeks safety and freedom from bother, accepting a modest return, Graham proposes a straightforward and largely passive portfolio strategy. The cornerstone of this strategy is a balanced portfolio divided between high-grade bonds and diversified common stocks. He suggests a split that could range from 25% to 75% in either asset class, with a common recommendation being 50-50ths. The key here is diversification and simplicity. The defensive investor should focus on large, prominent, conservatively financed companies with a long history of profitable operations and continuous dividend payments. The goal is not to find the next big thing, but to own a piece of sound, established businesses. Rebalancing your portfolio annually is also a critical component of keeping risk under control, and consistently buying low and selling high, for example. Stocks rise, selling some to buy more bonds to maintain a 50-50th split or vice versa. Example, a defensive investor might allocate 50% of their portfolio to a diversified index fund tracking the S&P 500, and 50% to high-quality U.S. Treasury bonds or a highly rated corporate bond fund. If, after a year, the stock portion grows significantly and now represents 60% of the portfolio, the investor would sell enough stock to bring it back to 50% and use the proceeds to buy more bonds. This disciplined approach ensures they are always taking some profits from their winners and reallocating to their less performing assets. Based on what has been expressed in this chapter, you should consider adopting a disciplined, balanced portfolio approach with a significant allocation to both high-quality bonds and diversified common stocks. Regularly rebalancing to maintain your desired risk profile and automatically buy low, sell high. Chapter 4. The Intelligent Investor and Market Fluctuations. Mr. Market as your partner. Perhaps one of Graham's most famous and enduring analogies is that of Mr. Market. Imagine you own a share in a private business, and every day a very excitable partner named Mr. Market comes to your door. Some days, Mr. Market is euphoric and offers to buy your share at an irrationally high price, or sell you more at an equally high price. Other days, he's depressed and fearful, offering to sell you his shares at a ridiculously low price. Graham advises the intelligent investor to treat Mr. Market as a servant, not a master. You are not obligated to accept his offers when Mr. Market is overly optimistic, pushing prices higher than the underlying value. The intelligent investor can choose to sell. When Mr. Market is overly pessimistic, pushing prices far below intrinsic value, the intelligent investor can choose to buy. The key is to understand that the market is often emotional and irrational in the short term. But the intelligent investor makes decisions based on the underlying value of the business, not on Mr. Market's mood swings. Example, during the dot-com bubble of the late 1990s, Mr. Market was highly optimistic about virtually any company with calm in its name, driving their stock prices to astronomical levels regardless of their profits or even revenue. An intelligent investor would recognize this irrational exuberance and refrain from buying or even sell off some holdings if they owned such companies. Conversely, during the 2008 financial crisis, Mr. Market became deeply pessimistic, driving down the prices of many fundamentally sound companies to absurdly low levels. An intelligent investor with cash on hand would see this as an opportunity to acquire quality businesses at bargain prices. Based on what has been expressed in this chapter, you should consider viewing market fluctuations as opportunities rather than threats, using periods of market irrationality to buy undervalued assets or sell overvalued. One's always guided by your assessment of the underlying business value. Chapter 5. The Margin of Safety. Your financial shield. The concept of the margin of safety is the bedrock of intelligent investing and arguably Graham's most crucial contribution. It refers to the principle of buying a security only when its market price is significantly below its intrinsic value. This difference, or margin, provides a cushion against adverse events, errors in judgment, or simply unforeseen economic downturns. Graham emphasizes that even the most meticulous analysis can have flaws, and the future is inherently uncertain. The margin of safety protects you from these unknowns. It's like building a bridge that can support 10 tons, but you only plan to drive 5-ton trucks over it. That extra capacity is your margin of safety. It allows for unexpected stresses without catastrophic failure. For stocks, this means buying companies that are trading at a discount to what they are genuinely worth based on their assets, earnings, and future prospects. Example, let's say through your analysis, you determine that a company based on its assets, earnings power, and stable industry is fundamentally worth $100 per share. Applying a margin of safety, you decide you will only buy shares if they are trading at $70 or less. If you buy at $70 and your analysis was slightly off, or the company faces some minor headwinds, the stock might only be worth $90, but you're still doing well. If you had bought at $100 with no margin of safety and it turned out to be worth $90, you'd be at a loss. The margin of safety provides that buffer against imperfection and unforeseen circumstances. Based on what has been expressed in this chapter, you should consider making the margin of safety a non-negotiable principle in all your investment decisions, only purchasing assets when their market price is significantly below your conservative estimate of their intrinsic value, thereby protecting your capital and enhancing your potential for profit. Conclusion. Your journey to intelligent investing. There you have it, a foundational understanding of the intelligent investor. This isn't just a book, it's a philosophy, a mindset that can empower you to navigate the complexities of the financial world with wisdom and discipline. Remember, intelligent investing isn't about beating the market every quarter or chasing the latest hot stock. It's about preserving your capital, avoiding serious mistakes, and achieving satisfactory long-term returns by focusing on the underlying value of businesses, not the fickle whims of Mr. Market. Embrace the roles of the investor, not the speculator. Understand the silent threat of inflation. Build a robust, diversified portfolio. Master the art of treating market fluctuations as opportunities. And above all, never compromise on your margin of safety. These timeless principles, though penned decades ago, are more relevant than ever in today's fast-paced world. Apply them diligently, and you'll not only safeguard your financial future, but also unlock the true power of compounding wealth. One intelligent decision at a time. Your journey to becoming an intelligent investor starts now. If you liked the video, give it a like and subscribe so you don't miss out on more best ideas in a nutshell.